What's going on, guys? Welcome to Collecting Keys. I am Mike the Hun here with my co-hosts Dan Austin and Dylan Cook. And if you're new to the show, that's a joke about Dylan. We make fun of him being a slacker because he's probably one of the most put together and highest achieving people that Dan and I know.
Oh, so, thanks, Mike. You're making up for last week.
Yeah. Well, as part of the bro code, we got to bring him down. You know, that's how it works.
I don't think I'm going to use this right. Mike, you'll be able to tell me on my lingo,
shit.
But is this called retard maxing? Is that what Dylan's doing?
We're going to put that right in the first,
have you heard of this?
Yes, I have heard of it on
You've
Twitter.
Heard of it?
Yeah.
What is it? I've heard of this, and people use it like it's like a normal thing to say.
No, it's like adjective maxing. It's now just a thing.
Oh,
or verb
yeah,
maxing. Yeah.
There's like that one guy that's like a looks maxer that was like all over like 60 Minutes and stuff for like a week and then disappeared.
Oh, I've never seen that.
Because he overdosed on meth in a club.
Oh, no.
Or fentanyl or some shit. But yeah, to your Dylan's point, it's like adjective maxing is like the current.
Oh, I thought like the R word was like a thing like a lot of people said. No, just in my circle.
Maybe
just
in a different context.
Yeah.
I would say I think that what you're seeing is the people that are picking up on how ridiculous of a trend the adjective maxing thing is.
Okay.
They're making
They're
joke
making
about
fun
it.
of it. Okay.
Yes.
See, I'm trying to get into this thing, but I'm missing the point, I guess.
But the thing is, it's dry enough humor that there's people that think that it's real.
That's what
You know?
I was like, that's real, dude. I don't know. What are they talking about?
I think
because like there's semi-serious people that I listen to on podcasts or Instagram that are saying it. I'm like, man, is that like a real thing? 'Cause that's pretty abrasive to say.
There's an X account called Autism Capital, and they use like an autism maxing the other day, and it's actually a good follow. Like that it was humorous.
Autism maxing or autism
both?
Trade? What was it?
I think the fact that you didn't pick up on that joke, Dan, means that you're officially like old now because
I thought they were joking, but like I didn't know if it was like a real thing. Okay.
No, dude, it's like when we were in like middle school, high school, and you have all the old people that are like, are kids actually out there crumping? You know, like
I don't even know what that is.
Getting crunk, you know, like doing crazy stuff.
I thought you said crumping.
I did. I meant crunking. But yeah.
Okay. I was like, okay,
so
now I know.
Yeah, you know, but yeah, and you could just like say like anything that was like kind of an inside joke that people would think was serious for some reason because some rappers said it. Except now it's not rappers; it's social media influencers.
Okay, yeah, I am getting old, I guess.
It's
I
the
just
time.
don't get the jokes. The problem is the guys I heard say it were older than me.
They probably don't know what they did, right? They're probably just like going along with the ride.
It's true.
That is something that I would say is kind of interesting to observe. And I don't know if it's always been like this, but there's definitely like a spectrum of millennials, like maturity and age, right? Because like we have like a finance business, which is kind of like a old person sort of job, right? But even like within the industry, like we are definitely kind of degenerates in there. There are people our age, Dan, who are professionals at like playing video games and like doing like shit to entertain children. Like there's like streamers and different stuff that are like our age, dude. And
job molesters who 100%.
No, even if they're not, like that's just like what they've done. Or like they are professional influencers that just make like ridiculous videos and do different things and probably make a lot more money than us, right?
I'm going to stay on this. I'm going to die on this sword that anybody that has an overall interest in entertaining kids or partial to kids is a child molester.
Well, okay, let's change the subject a little bit.
I'm going to die on that.
That's great. That's good for you.
Sorry. Don't disagree.
Like I can't agree or disagree.
In a similar vein, I think I was meeting with like a financial planner, wanted some money from me, whatever. But keep in mind, this guy's probably in his mid 40s. And he left, like, I said something, and his response was, bet. And I'm like, that just took it down deep for the, like, deep down, man.
There's
like,
a certain level where you just stop talking like kids. You should not do that. You should not take on, like, 13-year-old boy language.
Yeah, and then he's like, apologizes. Like, my kids say, I'm like, it's not helping. Sorry.
Well, next time you see him and he asks you how it's going, just give him like a 6-7. Do one of these.
I refuse. My pride would be hurt too much.
You'd be on his playing field. You're building rapport. That's what it's called.
Yeah, but I don't care about his rapport.
I did get a crash course when we had those kids working for us, adult children, by the way, working for us. I got like a crash course in like that stuff. I was like, what did he just like? I didn't know half the stuff they were saying. I had to learn.
Yeah, and it's funny because it's like being that age. I'm like, was I 21 going on like 15? I feel like I was kind of old when I was 21.
I definitely never used slang in a professional environment.
No, I definitely didn't either. Well, because like I was also trying to get like real jobs. We were trying to get into engineering companies.
Like we were like, you had to like work hard back then, especially to get a job.
I know. We had to go there. You had like your resume and you had your weird like semi-formal clothes that you had to wear to the office. I remember when I dug out this pair of pants that I had to wear to go to a job interview. And because I was
especially in college, because for all the listeners, I don't think Mike ever wore pants in college.
No, I just wore shorts everywhere. I was like the meme that you see of like the kid that always wears shorts in winter. That was actually me.
That was Mike for sure.
But then I had this pair of pants I needed to wear this interview, and I had never ironed them because they'd been crumpled in the floor for 4 years. And so I had to, find one of my female friends that actually had an iron to like help me not look stupid.
Use your hair dryer and iron.
Pretty much, dude. But I don't think they do any of that stuff anymore. Now they're all just trying to work remote or do something else.
Yeah, they don't. Yeah. It's a different world for sure.
And
it's changing rapidly.
I feel like we have to accommodate them, or you're not going to have any employees.
Dude. We just keep hiring like older folks.
That's true.
It's like it's so much better.
Yeah,
honestly.
There's like a tech gap, but you can get them caught up if they care.
If they care,
that's if they care. You can get them caught up.
There was an agent I worked with the other day that I think is legitimate 85 years old. She said she was been in the industry for 52 years, and I will tell you, the dot loop like shenanigans were not up her alley.
Oh man.
That's so funny. But, that's unfortunately what's going to keep happening, especially as people don't have any kind of retirement or pension, those kind of things. But,
dude, one thing, I'll just close the loop on shit talking old people.
I'm not saying anything bad about them. They're great.
Well, Dylan definitely was.
Yeah.
Respect your elders, bud. No, the one thing I don't get with some of these title companies, because they are usually older ladies that do this, I noticed. It's so weird to me. It doesn't bother me one bit, but it's so strange that I've picked up on, is they will print documents only to scan them in and send them to you.
I know.
You could have just sent the PDF.
That is hilarious.
Dude, we have borrowers, to be fair, that do that as well, that are younger, particularly if they're like more blue collar flippers, where they'll like be printing their bank statements and then like taking photos of them and sending them to us. I'm just like, dude.
You could have just print a PDF, dog.
Not even like scanning. They're printing them and then taking pictures with their cell phone.
Yeah.
Like, what are you doing, dude?
Yeah, you see some wild stuff, but...
Hey, I think I know where I want to start the serious part of this conversation.
Okay. That was serious, by the way.
Our mutual friend, previous CCF and Scale member, Tyler...
you forgot Scale already?
I was like, man, I had to pause.
That hurts, dude.
He put out a video of how Brandon Turner's fund, their Class B investors for a specific Houston property, lost 100% of Class B investors' money. Total loss.
Which is crazy.
Yeah, he lost a little chunk there.
Did you watch his YouTube video on it?
I did watch it. I think the biggest thing to put there is like, one, he was really pissed about like the communication aspect. Like clearly it was going downhill before like they said anything. And Brandon being on podcast saying like I work an hour a day and like wasn't taking it seriously until it was almost like it was too late. And two, I think one of the points we've even made on this podcast is like if you invest in real estate, the likelihood of going to zero is like we think is pretty slim to none given, especially relative to like buying a business or something, right? That we talked about. But so put your money with the guy with such a well-respected brand and an operator, and your $75,000 or $100,000 goes to literal zero, like is kind of wild to me.
Yeah.
Yeah. So it's a different kind of investment though, right? And so if you actually own the asset yourself, the chance of it going to zero are relatively low. You can technically lose enough value that all of your equity goes away, and that was just the debt. But that's when you kind of walk away from the property back to the bank kind of thing. When you're an LP investor, like you are when you participate in things like his Open Door Fund or whatever, was it Open Door?
I think it was, yeah.
You need to understand what that actually means, which is that you are basically making typically an equity investment in a property, in a singular asset that they are buying. There is a first position lender that is above you, and that money isn't going one-to-one to equity. It's going to be going to their company's operating costs in terms of fees. It's going to be going to renovations that they're doing. It's going to be going to actual capital expenditure that goes into the property that they anticipate is going to increase value, but it might not. And what can happen in deals like that, where it's a multifamily property, the cap rates get so compressed that the value completely goes away and there literally is no more equity to capture. And not only that, but there's no way to, even if there was equity, there's really not like a buyer pool to be able to capture it, right? Or like your LTV on that thing can be so low that even if they wanted to refinance it or capture the money, they just can't. Like, there's nothing that they can do there.
I mean, it sounds like they were putting $15,000 to $20,000 into each unit, and let's say it was running for $1,500 a month. Post renovations was running for like $1,200 a month with concessions.
Nice.
So not only you're putting good money into a bad asset at that point. Like,
yeah. And the thing that's also crazy about this too is I don't know how their deal was structured or the details of it, but very technically what could happen is the company that bought this asset, they could go, oh yeah, sorry, all the investors lost all their money, thing got compressed, most of the equity's gone, but we still own it. So we're just going to basically hold on to this deal for the next little while and essentially just tell the limited partners by the terms of this agreement that, sorry, it sucks to suck. And so now they have an asset and they basically just took all your money to do the deal and they're going to pay you nothing back as an investor. And this is always one of the issues that I've had with these LP syndications and these limited partner type investments is if you look at what they're realistically going to pay you, people will go and like, oh yeah, I get like a 12% IRR, 15% IRR. The downside risk on that is immense for what you're getting, honestly. And like when we first started getting into GoBundance and these different sort of larger groups that had all these people that are syndicating money or that were so heavily invested like that, it never made sense to me because you're giving up complete control over your money and the deal. The downside risk is 100% of your investment, plus potentially more, because they can also do capital calls, right? They can do other things that can influence how much money you have to put into it beyond what you originally commit. And the return isn't even that good for that kind of risk versus like what we were doing back when we sort of got in those circles back in 2021. We were flipping houses, whereas like we could put $50,000 into this thing and pull $80,000 out in profit 6 months later. I was like, why would I ever put $50,000 into something like this to hopefully make 10% IRR this year and then maybe get an equity multiple in like 5 years when it can all go away? It just never made sense to me.
When you're in a growth stage of any business, especially if like you're, I don't know, a younger hustler, I guess, like it hardly makes sense to even like the stock market, like
totally
more makes sense to like, and we can objectify that. Like we have return on ad spend numbers. Like every, dollar I put in results in $6 out. Like you can't beat that kind of return. Yes, it's more active, but still.
Yeah. And when you have, to your point, when you have a lot of surplus cash, you can explore things like this, right? It makes more sense because you're at the phase of your life, you're an investor. What was really dangerous about what Brandon did and that whole thing is he was pitching this to people that loosely qualified as accredited investors, right? And he's like, oh, you have $250,000 total in liquidity. Why don't you give me half of that? If you lose that, it's like catastrophic to you. Versus now, like we've gotten to a phase now where Dan and I have accumulated enough liquidity that if I do make an investment like that, it goes away. It sucks, but it's not the end of the world, right? And we have a high enough regular income that we can kind of deal with it. And also too, at our point with the business, I don't really know if I was to put $500,000 into our business, what it would do.
Right.
I actually am in a position where I have surplus liquidity. And that's when you should be making these sort of LP investments, not when it's like
you can pay your taxes.
Yeah, well, I already did that.
I know.
But you're just playing small time, Mike. That's why.
I know. Totally, dude. You reach a point where you don't need to play big time anymore. If you don't want to. Yeah, like if your goal is to be worth $100 million or $1 billion, you kind of do.
You got to keep putting chips on the table. To be a billionaire, you got to put your chips on the table all the time, multiple times.
Absolutely. Especially if you're trying to like grow something with super scale. Like the Elon Musk is a good example of this.
Yeah.
Where if you look at all the sort of situations that he had where he had big exits, I forget what the very first one, then he had PayPal, and he had other ones. Basically, he just took all that money and just rolled it into the next thing.
He was R-maxing.
He was R-maxing for sure. And he still is doing that.
Yeah, he is.
But that's why he's going to be the first trillionaire is because he's just doubled down so many times, and gotten lucky. But you could also do that and, lose everything.
Backing up just a minute, what's the criteria for being accredited investors now? Because it hasn't changed like so long that it should probably change.
No, it's $1 million in net worth, or
excluding your primary.
Excluding your primary, right? Yeah,
excluding your primary, or it's $250,000 a year in income as a single person, or is it? I think it's $400 as a couple.
Yeah, for like the last 3 years or something.
For the last 3 years, yeah. So it's like these days it's not a lot.
Yeah, it's super easy now.
I was gonna say that compared to like someone who's making that in the year 2000 is a huge difference.
Not only that, basically as the operator, you don't really have to verify these things unless you get audited.
Yeah.
Right. And so what you do is when you have somebody that makes an investment, even if you're a 506C, which is only for accredited investors, you basically just make the investor sign a form that says, yes, I certify on these things. I pinky promise that I am.
Yep.
And you're not required to verify anything.
That's wild to me.
And then you make them a millionaire before you get audited.
It's only 300,000 if you're married filing jointly. Let's look that up.
It's only 300. See, that's crazy,
dude.
Yeah,
Dylan, you're finally accredited.
Finally.
So, it isn't a lot, but the point is those you can, especially if you've owned real estate over the past few years, you can have $1 million net worth, have a relatively low income, and your cash position can be really low, but you can still make poor decisions like putting $100,000 into the open door fund and losing it, and that's all you have.
Yeah, my advice continues to be the same for anybody, like not you guys obviously, but anybody really trying to scale and grow is like, don't even invest in anything, not even the stock market. Like if you want to do a 401k because you got one, like do your 6% match or whatever your match is, fine. Like put $100,000 in your bank account. Then anything above that, start making some swings, and maybe you want to start doing some investment, but get $100,000 in your bank account and then get enough money that you can invest into something above that. Because like so many people are like, well, I've got $13,000 in my bank account. What should I put it to? It's like nothing. Leave it.
Yeah.
Just leave it there.
Put it in a high yield savings account if you want to feel better about yourself.
And especially when you're just starting out, like when you have $100,000, like that feels good. It gives you a mental clarity. And then if you want to level up and you're around the next guys, having $1 million in value, not cash, but like in net worth, gives you more mental clarity. And you keep leveling up as you grow and scale your ability to invest and your net worth, because there's something to be said about having a mind that's free of like being scared, the scarcity idea. Like if you have $13,000 in your bank account and you're taking 3 and you're putting it in crypto or whatever, like that is not comfortable like living unless you're R-maxing and you just whatever this means. But if you're just being a dummy, right? And you have no like risk sensors in your brain. But for the average person, like that's going to be a risky investment, whether you know it or not. And you're not going to be able to sleep at night. So get $100,000 in the bank.
Yeah. I mean, or like just the old sort of adage of have, a year's worth of your monthly expenses saved up. That gives you a lot of peace of mind.
A year of monthly expense, what you said? Okay.
Yeah, like a year of reserves. That's right.
$600,000-$700,000 for me.
For you. Damn, you're no wonder you're so high strung all the time. You're stressed. I know you don't got that.
Yeah. No, I'm not there yet. That would be wild.
Yeah, so that total loss, be cautious.
That sucks.
And just because someone has a big following on Instagram doesn't mean that.
Well, here's the thing. Like if you look, so Brandon Turner, he started that kind of the height of his brand. Smart move on him. He was making so much money. The market was awesome. But if you look at his credentials, what were his credentials? He had like 5 properties, 6 properties, whatever he talked about.
He was the bigger pockets guy, man. Those are the credentials you need.
Like when I look at if and when I choose to invest in other people, I'm truly investing in that person as a good person, which Brandon Turner, I think, passed that test. But then also, are they a good operator of what they do? Have they built their business that is actually something that you're like, oh, damn, that's pretty cool that they've done that?
Well, and also, are they actually the operator? Are they just the spokesperson?
Yes.
Which, when he's the person that's bragging about working an hour a day and spending all the time on the beach with his kids, whatever else, no, he's not the operator.
No, and he was very clear about that. He was partnered with whoever, right? Like would Disrupt Equity or Disrupt Capital or whatever it was.
Brian,
they were the operators.
I forget his name. Brian something.
And there's a lot of people that are like that. Investor Girl Britt's the other one that you see popping around all over the place where she's out there raising money. But she's not involved in these deals. At least I'm assuming she's not, because she's always in like Belize or Italy or wherever the hell she is.
Well, I mean, I can get behind raising capital with her, but Brandon.
I think someone went south there if you're reading in between the lines, because she had an Instagram post that said like, this had a massive deal fall through. And to me, my mind immediately goes to something with AJ Osborne probably got fucked up. But
right, for sure, yeah, because I think she's his main capital raiser.
Mm-hmm.
But that's speculation.
We're just jealous. We all just wish that we had our own fundraiser that could bring us a bunch of money so that we could not lose it like these dummies.
Yes, heck yes.
There are good people, but like you want people that have been in the space for a while. Like Drew that was on the show a couple weeks ago.
Good example.
He has his fund. I invested money with him because I've known Drew for a long time. He's one of like 5 people in the world that I would actually trust with my money. But he's also been an active investor in the space that he's raising money for like a decade, since before I've been in the game at all.
Yeah.
And this fund he finally did begrudgingly because he realized that he was going to need to do that in order to continue growing his business.
Yeah.
So that's what you want to look for. We're not someone like Brandon or these people.
Every LP position is an apples to oranges comparison. Like there's not one that's the same.
Yeah.
So.
Nope.
So anyways, Dylan, you're dealing with some evictions. That's fun.
Yeah.
What does an eviction look like in Ohio? Because Ohio, I guess politically, they are purple.
Yeah, I mean, major cities are all blue, but the state itself is red.
Isn't that everywhere?
Yeah, probably
at this point.
But we sell it's more landlord friendly. So here's the two things. If you just like non-renew of lease, it's a 30-day notice. Non-payment of rent is a 3-day notice. But to actually get someone like you file the eviction, you go to the court system, get them out is a minimum probably 45 days.
That's pretty fast. That's pretty good, man.
Yeah, 45 to 60 days.
Yeah,
about right. That's how it should be.
I think to increase rents here, is it 6 months now, Dan?
Yeah, it's like 180 days.
To increase rents, is that what you said?
Mm-hmm.
I talked to my property manager the other day about increasing rents on a property that comes up for renewal at the end of December.
Wow.
Yeah. And so Washington, the way it's set up is like they're basically getting you out of being able to do 6-month leases because you have to give them, 180 days of a rent increase. And then you have, what was the thing with 6-month leases? Why you basically don't want those? Because essentially you can't kick them out, not kick them out.
Yeah, so you can do 6 months. If they are less than 6 months, they basically treat them all as month-to-month leases.
That's
and
right.
The problem is the non-renewal and like the eviction notice is like stricter in what you can do.
Yeah, it's like 120-day notice or something like that you're not going to renew it.
Yeah.
On the 6 month or less or something like that.
Yeah, something like that.
Because it defaults to month, which if they're month, you got to give them 120-day notice.
Yeah, because what they're trying to do is get away from these landlords that always people on month-to-month notices. They would just increase like double or triple like overnight because they could. And then also what was very common is you would have these, Dan's point, these leases that would go to like month-to-month. The tenant would be ignorant to them. A new person would come in and buy the property and then immediately just like jack the rents up super high.
Mm-hmm.
Yeah.
Mm-hmm.
I feel like that must have been more of a Seattle thing because we don't really have that over here. You can't jack the rents up that much.
Well, you can't, but like you can't have them expect them to pay it. But I mean, that was honestly kind of our strategy with some of the distressed properties that we would buy back before they made these rules where we had a tenant that we needed out and getting them out was tricky.
I feel like that's different though. I feel like that's different. When a tenant's paying $400 a month and they haven't paid their landlord in like 3 months, even though it rents for $2,000.
Totally. When you look at it logically, it can be different. But when you look at it from the handful of cases that they use to create the rule, they don't look at the rational situation. You guys know how the government works. There's always like the one extreme that basically sets the precedence for everybody else.
Yeah.
You know, and so like to Dan's point, that we ran into that a lot is you would have a really awesome home in a great part of town. The property was kind of a dump. We bought it from the estate of the person that died and like the kid wanted to be done with it. And we would go in and like the family that was in there was someone that had been there for like a little while. They were massively underpaying on rent and they wanted to stay. And that was totally reasonable. But we're like, no, we can't have this house where they're paying $400 a month, especially with how much work needs to be done here. That's not the business model. And so we would either cash for keys or we would increase rent so that they would leave. Or like we actually have a couple where we increased the market rent and they said, cool. And they just kept paying and they never left and they're still there.
Yeah. Yeah. We've had that a couple times, but we bought a 4-unit property with the intent of redoing all the units, right? So we bought that at the end of March. You have to, like, it's a 30-day notice for non-renewal of lease. All of the tenants were month to month. So we posted a notice the day that we bought it. But in the notice, it says, hey, we're not going to charge you April rent. And if you're out by the 15th of the month, we'll pay you $500. 3 of the 4 we were just gone and they got their $500. Mm-hmm. And then the one stayed to the end, but we never had to file the eviction. So we do a combination of cash or keys. And in this situation, just because you do feel a little bad that you're like, asking these people to move, we're not going to charge you the rent because technically if you wanted to be this person, you could have charged the rent. They wouldn't pay it. You charge them a 3-day notice and now they're out even sooner. So it's a give and take in a lot of these scenarios.
It's the ethical guidelines, right?
Yeah.
Like you get to choose what that means to you and how you want to act on them.
Yep.
Because you're legally, you can do whatever you want. And depending on who you talk to, some people just go by like, well, legally I can do this, so I'm going to do it. But then there's also the human factor.
Totally.
Which plays into these things that you have to consider.
Here, this is a good example that kind of plays in a similar scenario. We have it's a would you do this deal question to Mike and Dan.
No. Well, I know Mike will do anything.
No.
Let's just pretend you might.
Whenever people have a hypothetical deal, I'm like, I already know it sucks. Otherwise, you wouldn't be telling me.
No, here we go. So ARV is like $525,000. So Class A here in Cincinnati, right? A good area.
Yeah, for that price.
Hey, I'm pretty sure that's where like the celebrities live, where you're based.
Is that like a 1 billion square foot house?
Yeah. Is that where like all the NIL like Cincy basketball players are now?
They'd be in a neighboring neighborhood. Anyway, ARV is like $525. Probably needs like $40,000 in rehab. We can buy it for $350. So like all in low 400s. about $100,000 spread after it's all said and done. However, current seller wants their current tenants to stay in the property with a 1-year lease, and at their current lease rate, you'd lose about $1,000 a month in holding costs.
No, I wouldn't do it.
Yeah.
I mean, it's not bad just to have a deal. Like, honestly, if you look at the economics.
Yeah, when you account for the loss in what you're losing.
Yeah, my guess would be it's like a $60,000 profit potentially.
Yeah, and you account for market fluctuations. You account for anything can happen in a year. We have seasons. We have tenants do weird shit.
And if tenants know they're going to be leaving, they could just tear the place up.
Which we've had happen. Like that is a big reason. But also too, I like, especially when I'm buying properties, I like to do it with, like, make my decisions with numbers that I know right now. You're expecting things to be exactly the same a year from now. And there's so many things that can happen over a 12-month period. And you have the ultimate unpredictable thing, which is the tenant that's in the property that you never know what they're going to do.
So the follow-up question is, okay, if it's not $350, is there a price? It's like, this just might be worth the squeeze, right?
Always a price.
Yeah, there's always a price. I'd be at probably $300 on this. Then you have a legit $100,000 spread. But then also what I would do is I would close on it. I would go to the tenant. I'd say, hey, I know that they're going to let you stay here. I will put you in this other unit that I have that's empty, and I will give you $5,000 to move there. I will give you rent credit for 6 months. I would incentivize them to leave. And so that way I can make more money on this house instead of having to wait it out.
Yes. Yep. And there's a lot less variability in what could happen. I agree.
That's what I would
totally agree.
So to be somewhat of a opposite opinion, I don't think it's a bad idea to do it, just given the circumstances, right? I personally wouldn't do that deal because I don't have a portfolio of properties right now that can absorb that, because there's a potential loss. But you could probably set it up to make sure you guys obviously have landlord-friendly laws. And if the tenants, if you get the opportunity to interview the tenants and get them locked into a solid lease, right, that makes sense for you that you would normally do, and the deal's solid.
Right. Or you approach them instead of, hey, of $1,500 a month, you guys want to say, but it's $2,200 a month. And now you're, stuff like that.
Right. I feel like you could work something in there where you could do like a different, some sort of longer term loan, or you could figure something out. The one caveat to that, just knowing the price points in Cincinnati, I wouldn't do that deal. I probably wouldn't do that deal in Spokane because it's tending on the higher price point of the market. And I just don't like to be on the upper third of the price point for that market. So like that to me is actually the more red flag of doing it.
I would say it's almost a more dangerous zone than like the higher tier. Like if this was in Spokane, Dan, because that 525 is like the middle tier, right? Like at this point.
But for like the houses that we're like our bread and butter flips, that's on the higher end.
That's getting up there because like the $800,000, $900,000 houses will sell pretty fast in town.
Yeah, totally.
But like that 6 to 4 range is where the super dangerous zone is. So I don't know what that looks like in your area.
Yeah, if I'm going to go and even if say it's a $400,000 loan on hard money loan, I'm looking at $4,000 a month in carry cost.
Mm-hmm.
Maybe a little bit less, but when you look at taxes and insurance and all that sort of stuff, you're right around $4,000. Like that's a lot of money.
Yeah. So the plan is to go back and go with hopefully a lower purchase price. So
yeah, and just get it for a price that just makes sense.
Yeah.
What's their reasoning for the tenants stay?
They lived in this house. They moved out. They're family friends. Like they're not real estate people. They just accidentally got into a rental house.
One thing that it's not necessarily the best thing to do, but like I always would tell like our acquisition managers and folks that were in People and Scale, like when the seller has like a weird ask, like I want my cat to continue to live under the house for the next 2 years, put it in the contract, because purchase contracts have nothing to do with landlord-tenant contracts. You can put anything you want in the purchase contract that says, I will come over every afternoon and make sure your tenants are happy. Once the property's sold, that's not binding with the landlord-tenant laws. So you can kind of get wherever you could say that. You could write it in the contract that they'll stay there, but then just go renegotiate with the tenants and be like, hey, I know the seller said this, but honestly, what if I gave you like $10,000 right now to move out? And they're like, yeah.
Yeah, right.
You know what I mean?
Yeah.
It's honestly probably something you could easily put together.
Point being, though, is like there are levers you can pull. Don't just give up if like...
Yeah. It's not an automatic no, is from my perspective.
No, it's definitely not.
I don't like that deal structure at all, but like it's not a no.
You have to massage it a little bit.
Well, the carrying cost on this big of a loan is it's a lot, right? That's the other part. So
I would say too, from our experience, we would also regularly run into sellers that were sympathetic to the tenants for some reason. They always had a story. More often than not, that tenant sucked. You find out that they were basically taking advantage of the old couple landlord that was gracious to this person that just got out of prison.
Exactly.
And they were like a piece of shit human being.
That's common.
So common, dude. We would run into that all the time. And they're like, oh, we just can't, he's been down on his luck. We just didn't tell you that part about how he's a child molester. I'm like, you fucking should have told me that.
Dude.
Jesus.
Yeah.
We're trying to work through a probate one right now where like basically this son is trying to take everything that his mom owned, but he has 2 sisters that technically have right to some of this shit, but he's like estate sailing shit out of the house from like on yard sales that he's not supposed to do yet. Like it's just a big mess.
Nice.
Yeah. So it's just the fun of off-market real estate.
Yeah. It's part of the game.
Yeah. So yeah, let's see what you do with it though. I'll be interested. I mean, price chart for everything.
Might be coming to you with a loan.
Yeah.
Right.
Yeah.
We might deny it.
Yeah, you might. Now that you know the backstory.
Right? Yeah, you should have said all that.
Yeah. Note for the audience: tell your lenders the least amount of things fucking possible.
Yeah. You know what? I'm on the back and I'll find it. I'll sniff it out.
How much of being a lender is like a private detective, right? Like you have to figure, with the borrowers at least, like, right?
Yeah. Partially, yes.
There is like truth to that. So like what people don't understand as well with the private lending space, and this is whether you work with like the large companies or you work with your local like hard money lender. It's completely discretionary, the loans are. So you can be like 100% approved from a credit standpoint, from a deal standpoint, liquidity standpoint. If you give off some weird vibes, they'll just reject you.
Yeah.
It's not like a Fannie Freddie loan where you have all the fair lending laws and all that kind of stuff. That doesn't exist in the private world. And so like if you are kind of oversharing stuff or you have like a weird situation, or like we were talking to our new sales crew, we had a whole bunch of new part-time salespeople start this week. And one of them was like, yeah, so we have this borrower, like he has a ton of extra stuff. It's like, yeah, needs some money to basically do some repairs on the property. It's almost a paid off house. Like, that's fine. And he said, yeah. And he said that he needs the money because he got put on disability and he's fallen behind on some of his medical bills. I'm like, okay, I don't need to know that because now what's going to happen is how are they actually going to pay for this deal? Is this actually a rental? Or is he just like saying that and he's trying to get like a home loan on it? And there's going to be all this new scrutiny that comes through because this person overshared. And it is a triplex, okay, but it's not uncommon for people to own these multifamily properties and to live in them, right? Even though that's illegal for them to do so. And so like, as you're going through any of these conversations with lenders or people that you're looking to borrow money from, just be tactful about what you're sharing. And don't get offended if they ask for additional information because you overshared. Because also that's another thing is if you get triggered when people ask you a question, that's also another red flag. Yeah. That's kind of like when you catch a kid that has their hand in the cookie jar and they're denying that they did, even though you saw them.
Yeah.
They will reject loans for that. Yeah. We have had investors reject loans that we were going to fund because the borrower did something that was kind of weird near the end.
Like they gave me the ick. That's the new terminology.
Yeah. Totally. What'll happen is when you catch somebody out and they'll like have a reason to deny it, and then the conditions that they'll set for it to be funded will be like pretty outrageous. So a good example, we had one, the guy said that it was an empty property, right? Or it was not vacant. The appraiser shows up, there's somebody's living there, right? And we're like, oh, what is the situation? He said it's vacant, somebody living there, there's like, stuff in there. And so we bring pride further and he goes, oh, well, my mom has been just like staying there, but she's going to move out. Come on, guys. The investors aren't stupid. They know your mom's going to live there for free. The whole premise of a DSCR loan is you have rent to cover the debt
service. Yep.
The debt service coverage ratio, right? And you're not going to have that while your mom's living in this house for free. It's not a rental. You basically bought a house for your mom. And so the conditions that we got was, okay, mom needs to move out. We need to show her having paid rent and a security deposit and a lease on her new property that she's going to move into. All of her stuff has to be gone, right? It has to be literally an empty unit. And you have to have a new tenant with a new like rent paid and a new security deposit. And they have to be in the process of moving in.
Well, there goes that deal.
Exactly. That's what happened. Yeah. I was like, oh, whatever. I'm like, yeah, there's now 9 things that need to happen before this loan can even start. And the thing is, if at the very beginning, he had just said there's like, oh, my mom's living there right now, she's going to move out. We could have at least anticipated that before he paid for an appraisal, before he spent a month getting us docs, before he ended up doing all this other stuff because he was expecting to pull one over. And if there's ever any BS, people will catch it and they will call you out on it.
If it's like a triplex and people are using the loans to move in, why would they not just use an owner-occupied loan unless they've already used that and they don't have another one at their discretion?
Easier loan to get, technically.
Really?
You don't have to apply your all your tax returns, all those kind of things, especially if you're like a newer entrepreneur.
Okay, yeah, so maybe more fringe cases than I'm thinking.
Yeah, rates can be comparable these days. It's not like it used to be where Fannie Freddie rates were like 4 and the DSCR rates were like 8.5, like when I started buying properties back in 2018. Yeah. There's a lot of reasons people do it. Honestly, generally too, DSCR loans are cheaper than like all the fees and stuff that get padded onto a conventional loan.
Dude, the conventional loans are fucking... Oh, can I say this real quick? We did a wholesale deal and this other guy was using a conventional buyer at the back end. And I looked at his settlement statement, like his side. Dude paid like $12,000 in fees for a $250,000 loan.
Dude, that sounds about right.
I'm like, the fuck? Like that lender just made a killing off of you.
Oh, yeah.
In that space, though, like it's kind of like a real estate agent where you're like, how do real estate agents justify what they get paid? And the argument is always like, well, if you look at the amount of work they do to source that, the length of time it takes to close a transaction, most loan officers in the conventional space are commission only, right? And so they kind of need to do that to justify how much work they do. And especially like, just like a real estate agent, those conventional loan officers, they're building those relationships over a very, very long period of time, whether it's with the agents or it's with the borrower. And they're probably only going to get 1, maybe 2 loans from that borrower over the lifespan of that relationship. Think about capitalism as a whole. Those sort of things, the costs, although they don't feel justified, they kind of make sense because you have to look at what the actual lifetime value is of that prospect. It's like, why the hell is furniture so expensive? It's because you're only going to buy 1 couch every 20 years. And if they sold them for what the couch was actually worth from like a material standpoint, the companies would never make any money.
I mean, wait till your kid gets older, you'll buy a couple.
Yeah, right.
But he made 5% of the total loan cost just on the loan, which is
that's crazy.
That's a good day. I mean, to me as I'm the borrower though, I know I can get better loans than that. And this guy was like a well-qualified borrower. He just like trusted the guy that was his friend.
And to your point, right? Like, it's ignorance as well, which is a really easy thing to take advantage of on the finance space or in any kind of like specialty, quote unquote, complex transaction space like that, right?
Well, good for the lender, I guess.
Yeah. Cool. Well, you guys have I just want to round it out with a quick question. Any predictions going into the summer? What are we going to see? Can do market-wise, big picture-wise? Is the market going to keep heating up like it has?
I am at a loss for words with like the S&P 500 right now. Like we hit new highs every day.
I have one word: corruption.
I knew that was going to be it. I almost said it before you.
Here's the thing. This is my comment because I am not qualified and I don't invest in the S&P 500 daily and trade and all that sort of stuff. Why is it not possible that corporate spending on AI is enough to inflate the S&P 500? Not inflate, keep it going and holding up the GDP.
I think because it's a numbers thing.
What do you mean it's a numbers thing? You don't think it's possible?
I don't think their CapEx expenditure can be big enough to support GDP for at least an extended period of time. Maybe a short term.
But for, I guess, up till this point, because everybody's like, I see all this, like, I don't know why the market's going up, blah, 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 blah. It's like, part of me says, well, like consumer spending is down. Okay. But corporate spending is way up. Everybody's investing in AI. If you're like, I just noticed on Gmail today, they have a new AI button in your Gmail, right? So it's like things are changing so quickly. People are spending money on it, right? So there's some expenditure at that level. You have like this gigantic factory Elon's getting ready to build for all these chips and all this sort of stuff. So there's a ton of spending. There's a ton of money because the billionaires continue to be billionaires, right? And they're taking all of this consumer spending and tax dollars and putting it in their little satchels. So is it possible up to this point, the reason why the stock market's going up and we're all like, why, is because of AI, and the companies that have all of the wealth are the S&P 500, which is like the Mag 7.
Yeah.
So going into the future, I don't have a comment on that. But
do you know what the Buffett yardstick is?
The what?
Buffett yardstick. So Warren Buffett, he has like a metric that's named after him. It's the total stock market value over annualized GDP. And he's been on record before saying like if it gets over like 100%, that's typically not good for the middle class. Today it's at 230%, which is like an all-time high. So like to me, like yes, could it still go up in the short term, but like it has to come back down with gravity at some point.
Sure. Yeah. Regression to the mean regression kind of
Yeah,
idea.
pretty much. Yes. Yeah.
Well, that only happens if people sell. And the thing is, most of the people that hold all the stocks have no reason to sell. So why would they? Just keep going up.
Well, okay, so let's layer in what there's the new Fed chair. When does he start?
This month, like a week.
This month?
Yeah.
So there's a lot of discussion about him bringing interest rates down, which would also increase inflation.
Yeah.
Correct. What do you think? And what do they call it? Inflation what do they call that when they're basically the debt destruction from inflation? You know what I mean? Where if you jack up inflation, you can destruct debt because the dollars are worth more, but the debt's...
It's financial repression is kind of what you're describing.
Financial what?
Repression.
Repression. Okay.
Yeah.
So basically the idea being is inflation wouldn't be terrible because it would allow the U.S. to pay off some of its fixed debt that they've accumulated over years because the dollar, you got to print more money.
Yes, this is the whole financial repression, playbook. Okay. However, who's that good for is kind of the thing for. And it's good for it. Yeah. No, it's good for asset holders, not really good for the lower or middle class.
Oh, yeah.
Because if you inflate away your debt, yes, that is a good thing for the nation, but not necessarily
and you feel wealthier, but you're really not any more wealthy.
Correct.
Yeah. Right? I mean, if you're an asset holder, you're wealthier than non-asset holders. So from who has money and who doesn't, you are much more wealthy, right? And that's the idea. Mm-hmm. So I don't really have an opinion right now. I don't see why the market over the summer would do anything major change than what it's been doing. I'll just continue to tell people you should be buying assets, whatever that means to you,
Yeah, I think it's going to keep going as it is at this point. Yeah, I would say we are beyond the point of reason, and you're kind of at the point where you should just focus on things you can control, accumulate cash, and then invest what you can afford to lose more so than ever.
Ditto.
Yeah.
Cool. All right. See you guys. Thanks for joining us today. You guys have a great rest of your week. We'll talk to you guys next time.
Yeah. See ya.
See ya. Glad to be back.
This episode is sponsored by Sir Lancelot LLC, also known as SLA Capital, which, if you didn't know, is Dan and I's private lending company. So yes, we are sponsoring our own show, but what you going to do about it? It is our private lending company that offers hard money and DSCR loans to real estate investors of all types. So you can be a new investor, an experienced investor. You can be buying flips. You can be buying rentals, whatever. We can do everything. And not only that, but the rates that we offer are just as competitive, if not cheaper, than pretty much every other company out there. So whatever big company you've been working with, bring us their term sheets and I guarantee you that we can probably beat it. We have the same connections they do. We just don't have all the overhead and middlemen. So if you want to come and check us out, go to slacapital.com/keys and I will know that you came from the show. And by seeing that you came from here, when you get to closing, you will save $500 on your first loan with us. So slacapital.com/keys, we would love to fund your next deal. Thanks for listening, everyone. If you want more from us, you can shoot us a follow on Instagram. I am at Mike_invest. Dan is at InvestorManDan. And Dylan is at Dylan_does_deals. Shoot us a follow and send us a DM to let us know what you think of the show.